this brief video, I'll be going through some of the concepts in Chapter 3. This video will discuss some of the principal elements of the balance sheet, as well as some disclosures that need to be made regarding some of those components on the balance sheet. I always encourage students to go through the full list of PowerPoint slides that are presented both in BlackBoard as well as in Connect. So some of the comments I wanted to make about Chapter 3 is that, as you recall from the earlier accounting courses, we list values of assets, for example, and liabilities at their historical cost. And so from the Accounting 1 and Accounting 2 courses, you would have taken comparative market value of these assets and liabilities in the market, especially assets. But consistent with the conservatism principle, we don't generally list under U.S. GAAP guidance those assets at that higher market value. And so the fundamental accounting equation that we're used to and we've studied in the past is assets equals liabilities and owner's equity or shareholders' equity minus liabilities. One of the things listed on the balance sheet toward the top, and we know that assets are listed in order of liquidity on the balance sheet, so the most liquid or easily converted assets easily converted into cash are listed at the top of the balance sheet. So we'll have cash listed first, and then we'll have other assets that are very liquid, usually maturing within 90 days, such as money orders, commercial paper, money market funds, and treasury bills. Then next we'll have some short-term investments that will mature within 12 months or a year. Various types of short-term investments, maybe those we intend to hold to maturity, such as a bond. Trading securities, those we invest in and with the intention of selling within a year, and then available for sale securities, which are investments we hold, and we have neither the intention necessarily of selling them or holding them to term, if it's in the case of debt, but we are open to selling them in the event an opportunity presents itself. And so we account for these differently, and we'll talk more about that in this course. Another asset we see listed on the balance sheet toward the top, a very liquid asset, is accounts receivable or trade receivables. A notes receivable generally is a longer term, and these terms then, these interest rate and payment schedule or amortization schedule, and all the terms that relate to that note should be disclosed in the notes to the financial statement. In a manufacturing environment, there are really three stages of inventories, which is another current asset, although less liquid than receivables. Finished goods, work in process, and then the raw materials. Work in process are fundamentally raw materials that have had some value added to them, but not all the value added to them. Not all the conversion has taken place yet. Prepaid expenses, these are assets such as prepaid insurance and prepaid rent. Investments, oftentimes these are larger investments held outside the context of our primary core business or operations. We may have seen an opportunity in purchasing land, for example, or other long-term receivables. And then these are operating assets, property, plant, and equipment are our fixed assets, and we report these then on the balance sheet at cost less adjustments for depreciation. Intangible assets, these assets don't have a physical presence, but they are assets that nevertheless need to be reported on the balance sheet, such as copyrights and franchises and patents. If we are amortizing these assets, then we would report them net of accumulated amortization. Current liabilities, again, these are listed in order of liquidity on the balance sheet. Accounts payable being a very liquid type of short-term liability. Accrued or deferred revenues are, for example, if an attorney receives a retainer, has not earned it yet, she would record that as a liability on her balance sheet. Notes payable, much like about notes receivable earlier, notes payable are notes that are longer term, and we have to specify those terms explicitly in the notes to the financial statement. I talked about earlier about deferred revenues, where cash is received ahead of earning it. Accrued liabilities, those that occur where we have an obligation but we haven't paid for it yet by the end of the reporting period, such as salaries, or we have the electric bill that came in and we'll pay next month. They've been expensed this period, but they won't be paid until next. Current maturities of long-term debt. So while the long-term debt may have been reported or classified on the balance sheet as a long-term liability last period, now that it's due within a year, we would move it forward or move it up on the balance sheet as a current liability. So we'll have a portion that's due within a year listed as current, in this case 100,000 of the million, and then the long-term liability of 900,000 is not due within a year, and therefore we'd list it as a long-term liability. Components, and finally, of ownership of a corporation: paid in capital or contributed capital, like when people buy stock in your company, and then retained earnings. The accumulated earnings from previous years are held as a shareholder's component of shareholders' equity as well. And then we'll get into, in this course, accumulated other comprehensive income. As I said earlier, financial disclosures really give a great deal of detail behind a lot of the numbers on the face of the financial statements, and they're exceedingly important to give context to a lot of those values. They'll also provide a summary of significant accounting policies, such as, are we using first in, first out, or last in, last out, last in, first out, for disclosures regarding inventory sales. And subsequent events are those events that occur after the reporting period, but before we've actually submitted or published our financial statements or issued them. And if we issued any debt or equity securities, for example, sale of significant assets, we need to then list disclosures that describe the event, the transaction, so that readers of the financials will have a sense of what their impact really is, and if it's temporary or permanent. A loss contingency, such as possibly a lawsuit that's pending against the company. What is the likelihood of that lawsuit prevailing against us, or an unfavorable outcome in that lawsuit, and then an estimate of the value if that's possible. Any related party transactions, errors or fraud, even illegal acts, of course, should be disclosed on the financial statements as well. So management will present a discussion and analysis, and it'll describe its view on how the company is doing, its trends, any uncertainties, and then it'll provide its context or its view of an analysis of how the company did, and I think more importantly, how they feel the company will be doing in the future. What are its, how liquid is it? How able is it to meet its current liabilities? How has the performance of its operations been this period, its primary operations in terms of operating income? And then what are its capital resources, such as the amount of stock it's sold or planning on selling, amount of debt that it's holding. For those companies publicly traded, they need to report to the SEC, or the Securities and Exchange Commission. One of the disclosures regards compensation for directors and executives. And then a proxy statement has to be reported as well with the annual report that's sent to the Securities and Exchange Commission annually on a 10-K. And they have this proxy then is an annual, where an annual meeting is held. They will ask if those not attending can provide a proxy to folks who will be attending, and essentially surrender or give up their vote on various issues that are before the board. So publicly traded companies must be audited every year, and there are four primary outcomes of an auditor's report. One is an unqualified or standard opinion. This is where the auditor has or audit team has completed the audit and found nothing that would rise to the level of providing any other opinion than unqualified or the standard opinion. Often an unqualified opinion will have an explanatory paragraph. It doesn't change the fact that you have an unqualified opinion, but there are things that the company may need to look at or should correct. And so they provide explanatory paragraphs. Qualified is a significant event where the auditor reports something that they found significant. For example, a major component like inventory on the balance sheet, those values on the balance sheet regarding inventory may not be reliable. And so that's significant enough for a manufacturer or a merchandiser to alter the opinion away from the standard or unqualified opinion and provide this qualified opinion. And that would be of great concern to stakeholders of this company of all kinds. And then an adverse opinion. Adverse opinion is really the worst kind of opinion. It means that fundamentally the financial statements cannot be taken at face value or relied upon. And so this is, again, very detrimental to a company, and often means that that this company may be under some significant financial or operational distress. And then there's a disclaimer, which means that the auditors have vacated or walked away from the audit engagement for a variety of reasons, and they feel they can't complete the job, they can't complete the audit. So they disclaim away an opinion. They provide no opinion whatsoever. So as I said earlier, unqualified is a clean, and that is in quotation marks. It means that there's really nothing, that, as I said earlier, that rises to the level of altering the opinion. And auditors are under an obligation, fiduciary, ethical, legal responsibility to conduct the audit according to the best practices of the profession. And that means they must significantly plan the audit, and they must gain an understanding of the internal controls. And for publicly traded companies, they have to provide an opinion on those internal controls. And then they do testing and gather evidence in order to defend or justify their opinion on a sample basis, in most cases. So an unqualified, with an explanatory paragraph, has not changed the standard opinion, but there are some things that, situations that need to be looked at, need to be, are of concern to stakeholders. Going concern means that the long-term viability of the company may be in some question as far as the auditors are concerned, but imminently there's likely the company is still solvent. A lack of consistency, especially in applying accounting principles, and a variety of things that could qualify as an emphasis of a matter, internal controls. There could be a variety of things, training of accountants, the way in which journal entries are made, safeguarding of assets. I talked about these a little bit earlier. A qualified opinion is very significant. They found something so significant that they cannot provide an unqualified or standard opinion, and that's significant and would be very concerning to investors and stakeholders of all kinds. And then adverse opinion, I mentioned earlier, is very serious for the company, both in the short term and the long term. Now, we talked about disclaimer earlier. So investors and other stakeholders then use this information to determine if this company is possible risk of defaulting on its bonds or other notes or other obligations, or if there's operational risks such as new competition in the area or its obsolescence of its products or services that would cause concern. And so we can quantify some of these metrics using various ratios such as liquidity ratios. You've had current ratio and asset test or quick ratio in previous accounting courses, and they help define how well or describe how well a company is positioned to pay its near-term debt. And they will compare the ratio, such as current ratio, to the industry standard, and that may give some context then to how well these companies are positioned in the various ratios of liquidity. One of the important relationships between risk and profitability relates to leverage, which is how much debt they're exposed to, how much debt they have relative to the income that debt is generating. And by the way, we describe that relationship oftentimes as debt to equity, which is just defines as capital position, the amount of debt the company holds relative to the amount of stock or equity it has outstanding. All right, so I encourage you to go back and continue to read the chapter, look at the other PowerPoints, complete the assignments, and always feel free to let me know if you have any questions.